Hello and thanks for tuning in to the Tony Denaro channel. Today we're going to be talking about the recent press announcement from Wells Fargo that they are going to be ending all personal lines of credit. Why that might not be such the conspiracy theory and doom and gloom scenario that everybody is painting it out to be, and what to keep an eye out for as they go into their earnings announcement for Q2 on Wednesday of this week. I don't currently own any Wells Fargo stock, but the reason that I wanted to talk about this topic really quick today is not only is my opinion different than many of those on YouTube, but as stock investors, keeping an eye on the banking sector is critically important, as any problems in this area of the stock market can be leading indicators of potential problems in the economy and the stock market as a whole. Now, if you're watching this video, you're probably already aware of the press release that they put out, but I'm just going to put it up on the screen and do a quick recap. Thursday, July 8th, the bank is shutting down all personal existing lines of credit in coming weeks. And additionally, Wells Fargo warned customers that the account closures may have an impact on credit scores. And that's because credit line closures can impact your credit score, and that is probably one of the most upsetting things to people. One thing that people are forgetting is a little bit of the history on Wells Fargo with their fraud back in 2016, and they got handed a very stiff penalty by the federal government in 2018, which capped their assets at $2 trillion. And that is the main driver of some of the lines of credit and other loans being ended by Wells Fargo over the last year, including this most recent decision, in my opinion. Just a very high-level overview of how bank balance sheets work. Any loans, including lines of credit that they have, go on the asset side of the balance sheet. And if we look at their most recent financial report, we can see right here in the middle that they have been staying just under $2 trillion on their total assets for the last few quarters, and that goes all the way back to 2018 when they received that penalty from the federal government. What you might not know is that when the coronavirus hit, companies and individuals both started drawing down their lines of credit, which forced Wells Fargo to have to make a lot of quick decisions to stay under that $2 trillion asset cap. Here's an article from July 2020 from the Wall Street Journal that kind of highlights that. When coronavirus was roiling the markets, companies collectively drew down hundreds of billions of dollars on their credit line, driving up the loans on Wells Fargo's books. This massive drawdown caused most of the bank's balance sheets to swell, but it put Wells Fargo in a particularly tough spot. The bank had to quickly unload assets, which is other loans, to stay beneath their $1.95 trillion asset cap. Wells Fargo has narrowly stayed under the asset cap over the last 2 quarters, that being in 2020, according to regulatory filings. And they did get a small reprieve when the Fed lifted restrictions so that they could make loans on the PPP. And looking at a second article from July 25th, 2020 in the Wall Street Journal, this tightening of loans is nothing new for Wells Fargo. As the pandemic took hold, Wells Fargo was early and aggressive in tightening credit. The bank made it tougher for some home owners to refinance large mortgages in April. It stopped accepting new applications for personal lines of credit in May 2020. And around the same time, it cut off auto lending through the majority of independent car dealership clients. It also said it would not take new private student loan customers for the coming academic year. Now, they did this for 2 reasons. Number one, to reduce their exposure to possible loan defaults, but also to stay under that $1.95 trillion asset cap. Now, when the pandemic started, Wells Fargo did a massive increase to their provision for credit losses, going up almost 500% what they normally carry. Right here in Q1 2020, we can see a $4 billion increase in their money they had set aside for potential losses, another $9 billion in Q2. Now, on the positive side, in Q1 of 2021, they actually had a release of $1 billion of those credit loss provisions released back, which means their losses were much less than anticipated, and that $1 billion went straight to earnings. That's why we see this major jump at the bottom here from the poor earnings they had in the 4 quarters of 2020 compared to a pretty solid result for Q1 of 2021. Now, as you probably know, banks derive the majority of their income from interest on loans. So let's just take a quick look at that for 1 second and talk about 2 different things. If we look at the bottom here, the average interest rates that they are deriving from their different loan products, I'm sure you're aware interest rates have been very low, and that's impacting all the bank's financials and their ability to show income on the financials. The average interest rate that they're earning for consumer lines of credit sits around 3.87%, with residential mortgages at 3.11 and home lines of credit, or the junior liens, at 4.13%. Keeping in mind that 1.95 million asset cap, one obvious thing that jumps out to me is that by eliminating the personal lines of credit, which aren't even earning them 4%, that frees up assets or loans that they can make on credit cards, which will earn them almost 12% interest. That's a huge increase to the bottom line when you're looking at earnings. The other thing they can do is cut their expenses, which they have already been working on for the past year and have said that they're going to continue to do. So as we go into the earnings announcement and the release of financial statements for Q2 on Wednesday, what are the things that you should be looking at for Wells Fargo to see if there's more to this tale than just figuring out ways to improve their interest income? Well, I know I'll be looking at their non-performing assets, because that's really going to tell us if there's a deeper problem that we need to be looking at. And when we look at these non-performing loans, really what we want to do is compare where they're at today with where they're at a year ago. So when we look at this column here on the right, March 31st, 2020, they were at 0.63% of total loans non-performing. If we look at March 31st, 2021, they're at 0.95%. So that's about a 50% increase. I'm not too worried about it as long as it stays under 1%. When we do a deep dive on these non-performing loans, the ones that kind of jump out to me is the increase in the office buildings, retail, and hotel and motel. So non-accrual loans have jumped from 14% to 17% in these categories. So that's what I'm going to be looking at. And until I see more data on Wednesday's report, I'm going to be going with the opinion that the elimination of the personal lines of credit is strictly a way for them to improve their income by switching the asset class to a higher interest earning category from personal lines of credit to credit cards. So let's stay tuned until Wednesday and see what the financial statements have for us. I'll be doing an update after they release the earnings to go over that, so please tune in. Thanks for watching. Don't forget to buy and hold that subscribe button, and please hit a like if you got some value out of this content. Thank you for watching.